G'day. It's Stefan Angelini from Angel Advisory. It's a beautiful Thursday morning on the 2nd of March, 2023. Let me give you a bit of an economic update. Today, I'm coming from my car, so do not judge me if the audio is not great, but I want to make sure I get this out because there's some good news floating around. Now, let me tell you what I'm going to take you through. Just three small topics today. What would happen if rate increases stop? So if the RBA stopped increasing rates, what might happen to share markets? Now, if the government has just stopped some Chinese investment into Australia, so obviously the government is looking out for our nation's best interests, and I'll give you an update on what they've recently done. And finally, I'm going to talk about Warren Buffett and his recent involvement in electronic vehicles, which he sees as a big economy and market going to the future. So if you're out there in social land, so what's that? Instagram, TikTok, LinkedIn, and you want to see the full video of this, please head on over to the YouTube or podcast. Now, if you want to continue on listening, just remember this is just general information. Please don't consider it as personal advice. If you want any personal advice, well, go and speak to a licensed financial planner. Guess what? We are those. So reach out to hello@angeladvisory.com.au. Just before we get into it, let you know why we're doing this. We spend a whole lot of time consuming content because we manage people's money from an investment perspective. So while we keep up to date with what's happening in the macroeconomic environment, why not send you a few little small snippets? So let's get into it. What if the RBA pauses rates? So at the moment, the RBA cash rate is sitting pretty high, and we're expecting that the RBA will increase rates both in March, so which is this month, by another 0.25, and then probably in April again, so another 2 rate hikes. And then what if it stops after that? So they've gone through already a pretty aggressive rate tightening policy and cycle. Now, while our GDP did increase over the last quarter, it's starting to feel the impacts through the economy. So we're starting to slow down in the terms that building approvals have slowed dramatically. So what that means, if construction slows down, GDP will slow down, people will have less jobs because such a large portion of our economy is construction. Consumer confidence has also started to decrease. That started to collapse. Now, that's going to flow through in the coming months when it comes to spending. So when people are less confident, that means they spend less. It's a clear recipe for actually an economic slowdown with housing slowing, confidence slowing, and finally, a lot of people coming off their fixed rate loans. That will cause a pretty good recipe for an economic slowdown. So what if after the April increase, the RBA stops increasing rates? Well, a lot of equity markets around the world have actually factored in that the RBA will go another 1 or 2 after April. So this will actually be a good sign. And that means equity markets will probably rally. However, let's look at the flip side. If the RBA continues to increase rates because people don't slow their spending as much, then you could likely see some pain in the markets so what equity markets do is they price in expectations in the future. And right now, expectations are saying, well, we might see rates stop in May and just start to slow down a little bit from there. So what you can do in your portfolios is just have higher exposure to quality stocks just to protect yourself from that increasing rates after April, if it does happen. So quality companies that have low debt, means that they will be able to weather a storm. Whereas if you've got companies with higher debt and obviously higher repayments because of higher cash rates, they will feel the impact the hardest. In terms of what's happening with Australia protecting our own interests, so the federal government has recently blocked a Chinese company from increasing their stake in a company called Northern Minerals. So a company called Yuxiao Fund, which is based, I think, in Singapore, but really strong ties to China, recently tried to increase their ownership in this company from 10% to 19.9%. So Jim Chalmers stopped it through the Foreign Investment Review Board, basically saying that rare earths are a critical part of modern military technology and are used in the production of weapons, as well as things like electronic vehicles. So in a statement basically saying that, look, resources are critical to our national security. So we don't want any country owning a large portion of these resource companies because, well, then they have control. Now, this isn't the first time this has happened. Back in 2020, Josh Frydenberg stopped a big group from taking an 11% ownership in a similar company. And finally, China has come out and said, well, this is just simple discrimination. This isn't in the nation's best interests and national security grounds. You're just discriminating, which I disagree with, and so does Jim Chalmers. So well done, Jim. Good job for protecting us, and hopefully we can remain a very strong nation with very resource rich. We're very lucky here. So that's us. in terms of Warren Buffett and what he's doing, so obviously everyone's been talking about electronic vehicles. We know they're the way of the future. Petrol cars will eventually be phased out. We don't know when, but Warren Buffett has actually taken made an $8.2 billion acquisition into a company that doesn't actually produce electronic vehicles. They're more charging stations, actually. So if you think about the old mining boom back in the day, why would you own a mining stock when there's so many people trying to do mining? When you can own the company that makes the shovels, which goes into helping on mining. Those companies do very well, and this floats well with Warren Buffett's strategy and investment strategy. So the company he actually invested into is called Pilot Travel Centers. Now, think of truck stops that they own or petrol stations. So he increased his stake from 38.6% to 80%. So he controls a lot of the company now. So this company has partnered with the likes of GM and Volvo to develop more charging networks for their electronic vehicles. Just to give you an idea of the scale of this, they have about 650 locations in North America, under a few different brands. But basically, they offer gas, they offer restrooms, parking, fast food restaurants, amenities to the people that are traveling. So there's a lot here in Australia too, which is why you're probably seeing a lot of interest in petrol stations and the like. Because these will be new charging facilities. Now, what happens with these people that own the department stores that are sitting there, like the 7-Elevens, if you ever fill up your petrol tank, when you fill up your fuel, you're only stopping there for a short minute. You fill up your fuel, you go in, and you leave. Now, these convenience stores, they make their money mainly by selling things to you when you come into the store. They don't make heaps of money off petrol. So what you could imagine is that when people go to charge their cars, they're going to spend a lot more time at these facilities. They're going to spend more money on food. They're going to spend more money on the goodies, candies, and the like that are actually in these stores. And that's where they make a lot of their money. So this is just Warren Buffett playing that game. He does still own parts of electronic vehicle companies, but this is his way to sort of bet on the industry rather than just on the individual companies and who will do well there. So it's a bit of an arms race in that regard. So that was my little economic update. A few small things for today. If you've got any questions, reach out to hello@angeladvisory.com.au. Thanks so much for listening, and I'll see you next time. Bye.